Now let's see investment process. This investment process, it involves five stages, and they are framing of investment policy, second one investment analysis, third one valuation, fourth one portfolio construction, and fifth one portfolio evaluation. The first one is framing the investment policy. At the time of investing your money, you have to make certain plans, and it is considered as framing the investment policy. Without having any idea, you are not supposed to invest your money. So first you have to think about investable fund. What kind of fund you are going to use to invest in different security, that you have to decide in the first place. So it may be your own fund or it may be the borrowed fund. You have to decide the investable fund at the first place. Second one, you have to set your objective. Why exactly you are investing your money? Is it because you want to earn more return, or it may be because you want to reduce your risk, or you need a regular income? Whatever may be the objective, you have to decide your objective in the second place. Then knowledge. It is not just banking banking an option which is available to invest your money. There are so many options which are available in the market, maybe shares, bonds, derivatives. So you have to learn about these options and make sure which one is beneficial for you, which is going to fit your objective. You have to see this. For that you need knowledge, so you have to study the market for this purpose. That is about framing the investment policy. At the time of framing policy, you need to fix the fund, what kind of fund you are going to invest, whether it is own fund or borrowed fund. You have to fix your objective, why you are investing your money. Then you should have the knowledge of different kinds of investment alternatives available in the market. That is the first one. Second one, security analysis. Once after deciding the funds or framing the policy, we have to do an analysis, that is security analysis. It can be done by doing three types of analysis, that is market analysis, industry analysis, and company analysis. Here market analysis is the first thing that you have to do. Here you have to study the market, in the sense economy, whether the economy is performing well. You have to see the GDP and the recession, deflation, inflation, all those things in the economy. What kind of situation is there? Based on that, you have to decide whether to invest in a particular economy or not. It may be domestic economy or domestic market or foreign market. You can decide based on the economic performances. Once after studying about the market, you have to decide you have to do an industrial analysis. You have to do an industry analysis. Here industry is a group of companies, so you have to search for the an industry which is performing very well. So there may be different industries like automobile industry or IT industry, pharmaceutical industry. So you have to see which industry is performing well, and then you can decide in which industry you are going to invest your money. After that, you have to do a company analysis. Here industry involves company. Once after deciding the industry, you have to see in which company you are going to invest. There may be you might have selected automobile industry. Under automobile industry, in which company you are going to invest. For that, again you have to do a company analysis. You have to compare the different companies performances and select a particular company. These are the things comes under security analysis. First thing, you have to study the market, in which market you are going to invest your money. After that, industry analysis. Inside the market you get industry, in which industry you are going to invest. Once after industrial analysis done, you have to decide the company, in which company you are going to invest your money. That is about security analysis. Third one is valuation. Here you have to do a valuation of the security. You have to see what is the real value of the security that is available in the market. For that, you need to know the intrinsic value, even the future value. Intrinsic value, it is called as the real value of the security based on book value and this price earning ratio. You can calculate the intrinsic value. This intrinsic value is very essential to decide whether to invest in that security or not. Here, there might be securities which are available at a very high price in the market which has a lower intrinsic value. It means the market tendency, the market trend get influenced by different factors. It is not necessary that the securities which are available in the market at a higher prices has a higher intrinsic value. There might be some inside trading that can cause the security price to go up. It means that this trend will not continue forever. It can The security price can come down at any time. Therefore, we have to be very careful. It is not just the market price which is available in the market at this point is important. We need to know the real value of the security. For that, we need to study about the intrinsic value. There might be a security which is available at a cheaper cost now, but it has a very high intrinsic value. In that case, it is better to buy that security because the prices may go up at any time. So we have to do a study of intrinsic value of the security. Again, future value. It can be studied with the help of trend analysis. It is just we can say our assumption based on our study, knowledge, experience, we will be able to understand the future trends in the market. For that, we have to do a trend analysis. Based on the trend analysis, we can study about the future values of the security. So understanding the intrinsic value and future value is very essential, and it is the third step of investment process. Fourth one is construction of portfolio. Here, portfolio, it means the combination of security. I might have invested my money in several securities, maybe shares, bonds, and debentures. Totally, they form the combination of all these shares, bonds, and these debentures. It becomes my portfolio. Here, portfolio construction is the fourth step of investment process. There are two things: diversification and selection. Diversification means investing your money into different securities. Here you are not supposed to invest all the money into one securities, rather you have to go for diversification. It means you have to invest it into different securities, maybe shares, bonds, and debentures, or sometimes you may have to invest in the securities of different companies or different forms of securities. This is because in case you have invested everything in one security, if the prices of that particular share or bond falls down due to certain reasons, you will lose everything, which is not at all a right way of investment. So you have to diversify this money into different channels. So there are different ways to do this diversification. First one is debt and equity diversification. Here, debt and equity diversification means investing some amount in debt security and some other in equities. Here, debt securities, they provide regular income to you. On the other hand, equity helps you to gain capital appreciation. So you can balance your portfolio with the help of this debt equity diversification. Second one is industry diversification. Here I said while doing industrial analysis, we will find different industries, maybe automobile industry, pharmaceutical industry, banking industry. So you can diversify your money based on industries. Some amount you can invest in banking industry, some other on automobile industry, some other portion of your funds in IT industry. Here there are certain industrial sector which can give you higher return. On the other hand, there are some industrial sectors which give you a constant return. Maybe banking sector or pharmaceutical sector, they give a constant return, and this IT or automobile sectors, they may give higher return to you. So you have to uh, invest some amount of funds in IT and some other in banking sector. That is called industrial diversification. Next thing is company diversification. I said industry means combination of companies. So under industries you will find several companies. So you can't invest everything in one industry. It means you have to select one particular company. You can invest your fund in different companies. That is called company diversification. Last thing, the second thing which comes under this portfolio construction is selection. Here you have to make the selection of the portfolio, that is done through this industry company analysis. You have to decide your portfolio by allocating the funds to different securities. That is selection. Next thing is evaluation. Here you have to evaluate your portfolio. Here it is a last process of investment process. It involves two things, that is appraisal and revision. You are investing with a purpose. At the time of explaining the first point, I said you should have an objective. Why you are investing, you should know this. And if you are investing for earning more return, you will have certain standards. So here under appraisal, you have to compare your actual performance with the expected performance. You have to see whether you're earning as much as you expected, or is there any difference. You have to study, you have to make a comparison. That is called appraisal. And revision, in case you're not earning as much as you expected, you can revise your portfolio. You can try to sell some shares and some buy something else which is going to give you what you are willing to buy. That is called evaluation. So these are the things that is involved in investment process. So that is about investment process. Thank you.